What is up, everybody? Welcome back. And today we're going to have a stock market update for December 16th, 2025. The market was all over the place today. We actually went down a little bit lower than we were at this morning. The market definitely dropped in a lot of areas, but it seems like we're recovering. There's a lot of uncertainty in the market right now, even though the Fed had a positive, in a sense, outlook of, when it comes to rate cuts and stuff like that. It did not pan out in terms of stocks and the numbers, okay? Today I want to break down why the market felt really choppy and confusing. If you guys were trading in today's market, you already know what I'm talking about. These candles, the wicks, they were all out of whack. And even though we got a ton of economic data this morning that would be modestly positive, we still had a day that dropped down, all the way down to 674 on SPY at a certain moment as well. If you're trading SPY, QQQ, or futures, this is one of those days where context mattered more than the headlines. And I think the week is going to be like this as well. So first thing I'm going to do is bring up an image on the screen for all of you to look at. And I'm going to talk about what this image means. Now on the top, you're seeing a quick macro recap. So a lot of green dots mean that the data beat the expectations. Red dots means the data missed. Underneath that is the economic calendar showing the actual numbers versus consensus. This is really important because the market does not trade on good or bad data. Okay, it's a big misconception. The market trades on how data changes the expectations and the overall sentiment, especially when it comes to the Fed. And today's data was very mixed, as you can see. We have some wins, we have some losses here. Here we see non-farm payrolls beat. We see private payrolls beat. Manufacturing payrolls beat. Now on the surface, all of that looks very, very good. I mean, you would think that it's bullish. Jobs are still being added, companies are still hiring, but this is the key part right here. The unemployment rate is what missed, which is what's really causing a lot of the market stir and the uncertainty. Unemployment came in higher than expected. I mean, this is being reported on a bunch of different headlines. Some of it saying that this is the highest unemployment ever, but the reality is it's just higher than what's expected. This is not something you can ignore, and I think with the AI tech bubble, it's causing a lot of panic. It's causing a lot of fear. We have unemployment at a high, and the evaluations of all these AI stocks are at an all-time high, and it's AI, okay? So what does AI do? It replaces people. So when the unemployment rates are very high and AI is doing very well, what do you have? A recipe for a disaster for the average American that works with their hands, that works with just them doing tasks. I mean, this is a massive threat. Even more important, the U6 unemployment rate jumped significantly. That includes underemployed and discouraged workers. So while we see jobs being added, the quality of the labor market is weakening. This tells us the economy is not overheating, but it's also not collapsing. So it's like a mixed bag. It's more so cooling. From a Fed perspective, that matters a lot. Next, I want to talk about consumer data and the selective spending. Retail sales are really important, and this is where things get very interesting. Overall, the headline is that it's a miss. Consumer spending came in weaker than what is expected. And this is a big month for that. I think that we're going to see the Santa rally where stocks typically increase, but they don't increase by that much. They typically increase by, I think, an average of 1.4% historically. So it's not a massive rally up that we're expected to see for consumer data, but it is a positive outcome. But hold on, core retail sales were beat and retail control was a very strong beat. This tells us that consumers are cutting back on discretionary spending, but they are still spending on essentials and necessities. So to dumb it down, people are being more selective, more careful, more mindful of the way that they're spending. And this is very common in the late cycle of the market that we have right now. This is like very, very normal stuff. Consumers are getting more selective. They're not pulling back. They're not being reckless. They're not being crazy with their spending, which is theoretically good for the economy. At the end of the day, it's not recession behavior, it's more so cautious behavior, which is what creates the market sentiment that this could be, a negative market, a bear market, so on and so forth. Now let's tie everything together. Today's data supports a softening but stable economy. It creates kind of an imbalance, a tug of war, a back and forth, if you will. The bullish interpretation are jobs are still growing, core spending is still strong, GDP contribution is still there. The bearish and dovish interpretation is unemployment is rising, headline spending is slowing, labor slack is increasing, and people are just being more cautious with the way that they approach the market. And there's a lot of talk of, this is a bad economy right now. This is exactly why the market chops on days like this, absolutely up and down. Despite that, we were still able to make over 100% gain on the trades that we took today, which is really awesome. But you got to know how to trade in markets like this. And this is what I really specialize in. The short scalps, the quick movements, the choppiness. I love the volatility. Personally, as an options trader, this is where I make my bag. You often see fake breakouts, which destroy traders. I've seen so many traders get destroyed today, including my first few takes of the day. They were all over the place. What I thought would be a good position was actually not, and I had to adapt to the market. So later on, we had two back-to-back plays that were over 100%, and the first two that we took were pretty much 60% losses. You see a lot of fast reversals that make, they're just, the wicks are crazy. You see a lot of algo-driven moves to the headlines. Here's what's happening. The market does not know whether to price in the growth resilience or the future rate cuts. So it does both violently. And when you look at the wicks, if you're being really technical with trading here, you see the candles stabbing. That's what I call it, stabbing, where they're like moving like this. And you see a wick at the top being formed, but the candles are moving in a very violent pattern. Now let's talk about the market moving news. Let's zoom out here for a second. One of the major things right now is the rate expectations. Like what's gonna happen with that? Traders are watching the labor data, the consumer data, and the inflation trends. And today's numbers give the Fed more flexibility. They don't scream that rates need to stay high forever. That they also don't scream emergency cuts now to save the economy. They keep the markets in a wait and see mode. And if you guys remember Powell's address where he was like, we're gonna let the market play out.
The adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
This is exactly what they wanted, which is really good for traders and the Fed. So this in turn means lower conviction. We're taking shorter term trades, not as many long-term swings, and effectively more volatility, which is good if you're doing those short-term movements because you can make a lot of money. On top of that, we're seeing if tech and AI has any signs of fatigue because some of these stocks are just rallying up. And we're looking to see rotation instead of broad market strength. This reinforces and really creates the choppy environment that we trade in right now. So I want to talk about how traders should think on days like this. I've kind of hinted at it already, but let me give you a more technical breakdown. So basically, it's not like a pick a direction type day, okay? It's not like a day where like we're gonna see the movement. Like a lot of traders look for, is this a bullish day? Is this a bearish day? In fact, today, there were many points where things were rallying up and coming back down, which is why you need to be more short-term in the way that you're trading, especially if you're a scalper. This environment actually favors more day traders instead of swing traders. You need to look at the reversions. You need to look at how to trade indicators, and it really favors technical analysis because there's not a lot of news coming out in terms of big momentum swings. In addition to that, you want to reduce your positions and you want to be able to average in. For my technical traders out there, I always go in light on days like this because I'm looking for the market to reverse against me and for me to maybe get into a better position, which is why we average in. When I go in my light positions, I typically do 10 to 20% and I average in another 20 to 30% there. And if I need to, I'll go in a full position if things really make sense. But I'm sizing smaller, my risk is smaller, but I'm taking more trades because the market is moving up and down. When macro data is mixed, patience beats prediction. So you got to let the market show its hands and move along with it. So to summarize, jobs are slowing. They're not crashing. Relax. Consumers are more cautious. They're not broke. The Fed actually gets what they want. They want more room. They want more data. They want more of a play out. And ultimately, the market, unfortunately for us, stays choppy. But if you know what you're doing, if you're experienced, if you're solid with this stuff, it actually means that you can make a lot of fucking money if you're able to hit the short-term scalps, be good with your entries and position size, and obviously know how to average in and trim effectively. This is right now a headline-driven, expectation-driven type of market, not a trend easy one of we're going up or we're going down. If you trade smart environments like this, you will survive the long term when clarity really starts to show out and we definitely get more direction and more of a solid trend. So with that being said, if you found this helpful, please consider liking and subscribing. If you guys ever want to see me trade live, join my private community. I would love to talk to you. You're more than welcome to DM me on Instagram as well. Links are down below. And like always, stay disciplined, stay focused, and take the green instead of the red. Peace out, guys.